Excellent. Just waiting for that live button to go. I can see we're starting to get our attendees on. Well, welcome back. Welcome to my presentation on U.S. tax considerations and solutions for non-U.S. based investors. So over the next 45 minutes or so, I'm going to try my best to answer some of the most frequently asked questions I get from non-Americans, non-U.S. taxpayers living outside the United States who have investments in the U.S. Either they want to invest in the U.S., want to buy property in the U.S., real estate, stocks, bonds, or let's say they have assets there from when they lived and worked in the United States and are looking to obviously tax optimize it, make sure that they don't have any nasty surprises or any traps on that. If you are new to this platform is called Webinar Jam. So hopefully you've been able to see this video, everything live on either your browser or your phone if you're watching it. If you see a menu, if you're on a desktop, you should see on your right-hand side there an option called Chat. And you will see the message area there where it says, don't be shy, start chatting. And you have an option there to either send a message to me, a question to me. I would ask, you can go ahead and send your questions there, post your questions there at any time. While I do my presentation, I'm going to be going through all of my slides and I'm going to be answering all those questions at the end. So for those of you who can hear me, again, if you're on a desktop, you should see that on the right-hand side next to settings or next to a bar that you can bring out. If you're on a phone, you might find another menu that lets you pull it. Can you please just go to that chat section and just type in a Y or type in a one quick message, just so that I know that you can hear me and that you can receive that, and I'll have no problem receiving your questions. Okay, excellent. So seems that we've got some there. Excellent. Okay, so with that, I'm going to go ahead and get started with my presentation. Everyone is online. So first of all, I want to present an important disclaimer. Please go ahead and take a moment to read it here. I want to remind everyone that everything I present here is for education and discussion purposes only. Nothing in this presentation is to be taken as tax advice. This presentation is also not investment advice. So we do not provide tax advice full stop. And we do provide investment advice, but just not here. Even if you are a client, this is not a one-on-one this is an open forum. It's not a one-on-one place for providing one-on-one investment advice. You can see on the SFC website and SEC website all of our disclosures and regulatory filings as you may need. So disclaimer out of the way, for those of you who may not be familiar with me, I just want to briefly introduce myself. My name is Tariq Dennison. I am a Hong Kong-based certified financial planner and trust and estate practitioner. I run a cross-border wealth management firm called GFM Asset Management. We are registered in the US as a registered investment advisor with the SEC at the federal level. And in Hong Kong, we have a Type 9 asset management license under the name GFM Group Limited, where we manage clients' retirement accounts. What we do is clients will open an account with us, either save money regularly over a period of time or contribute a lump sum, and we make sure it lasts over long periods of time well into retirement. So from the accumulation phase where that account is being built up, and then in retirement phase, making sure that that account can generate income. A big part of that plan, a big part of what we need to do though, is of course make sure that that income is tax efficient. Because if we've generated a retirement account that's supposed to generate $100,000 a year of retirement income for you, and you only get to keep $40,000 of it and $60,000 goes to the government, that's not such a good retirement plan. And there are ways that we can do that a lot better. I now have well over 20 years of experience in global markets doing this. I've worked at a variety of investment banks in New York, London, Frankfurt, a little bit of time in Toronto before moving here to Hong Kong 10 years ago. I have a master's in financial engineering from the University of California at Berkeley, and I'm a visiting lecturer at ESSEC Business School in Singapore on fixed income and alternative assets. My book is titled Invest Outside the Box, Understanding Different Asset Classes and Strategies, and you can find that book on Amazon or directly at the publisher site of Palgrave Macmillan or Springer. My focus generally is on ETFs, direct indexing, retirement plans, but more than anything, helping my clients understand what they own and why the assets that they've invested in are going to pay them, not just year by year, but all the way through retirement, and making sure that we can keep up with inflation and generate rising levels of income through time. And although I talk a lot about tax, I know tax is just an important part of it because we don't want to end up keeping a lot less than we hope simply because we didn't do proper tax planning. So who is this presentation for? Last week I did a presentation specifically for US expats, for American taxpayers living overseas, but this presentation is especially for you if you are not a US person. So meaning you are not a US taxpayer, this presentation is for non-US taxpayers, but you're a non-US taxpayer who either owns or plans to buy some form of US asset. Now you plan to buy US stocks, US bonds, US private equity, US real estate, and I'm going to explain a little bit why a non-US taxpayer would want to get caught in the tax net in order to make US investments. Or alternatively, you've worked in the US before, and from your time in the US, you have a retirement plan still in the US. I have several clients, several cases like that, where someone has gone and worked in the US for a few years, had a 401k plan there, and then has come back to Hong Kong or come to Hong Kong, never got a green card, never got a US passport, but still has assets there and is wondering what to do with it. And really what I want to try and address here is to help you understand what some of the common US tax traps are and some solutions to avoid getting caught in those tax traps. So some of the goals of this presentation for my non-US tax-paying audience is to define how and why non-US taxpayers would even want to invest in the United States and get caught in the tax net in the first place. Next, I'm going to outline some of the major US taxes and tax traps that non-US based investors should know about. Some of these are taxes that you may already be paying and may not be aware of if you don't check your statements. Some of these are taxes that may only hit you much, much later down the road when you least expect it. And I just want to make sure that you're aware of them and don't get surprised by them. And of course, I don't want to just present the problem. I want to present some of the solutions that we've used in order to solve some of those problems. Ultimately, at the end of the day, I want to deliver a good return on the time and attention you are investing in paying attention to this webinar. I know your time is valuable. I know sometimes I talk quickly, but I talk quickly because I want to make sure that I get valuable things across when you're listening to my FAQs, my answers to these FAQs. So on to the next question. Why bother even entering the US tax net? US taxes are complicated, but it's not just about taxes. We pay taxes because we make money, and we want to consider investing in the US because it's a big place with lots of opportunity to make money. What this slide shows is basically that the US has, by world standards, the world's largest stock market, the world's largest bond market, and the world's largest real estate market. That's those three columns here. The US, according to the FTSE All World Index, represents a little over 55% of the total world stock market capitalization, at least as measured by FTSE, and also represents 43% of the total world bond index. Now, these are Vanguard's numbers. You could debate a little bit how large China's bond market is and how much we should measure it there. But the fact is, foreign investors from all over the world buy US stocks and bonds. And then over on the right, this is really more of a measure of listed real estate investment trusts, because I have much better data on that than I do on physical real estate. But it probably doesn't that I know many, many more Chinese, Indian, European investors who buy US properties than I know Americans who buy Japanese properties or Singapore properties, and vice versa. And there are a number of reasons for that. The US has plenty of space, plenty of cities which are attractive to buy real estate in, very well-trusted property laws, security of property, financial privacy, and so forth like that. So it's a very big market with lots of opportunity to make money. And it can be well worth paying those taxes if that's what it takes. Second reason are just the performance and rates of return that investors have experienced, especially recently. So on the upper left-hand chart over here, you'll notice a chart that I literally just updated 7 minutes before this webinar began, showing the relative performance of three major stock benchmarks. So if we divide the world stock indices, the world stock markets, into three parts: the US, developed markets other than the US, and emerging markets, the US market is the blue line. And you'll notice that if you had bought all of these, all three of these index funds back in 2003, when the latest of them launched, both the US stock market and emerging stock markets would have returned about the same, but emerging markets would have given you that return with a much, much rougher ride. So initially, emerging markets did much, much better than the US throughout the 2000s, but you'll notice that if you had invested after that amazing run in emerging markets, if you had bought Chinese stocks in 2007, 13 years later, you'd have about the same amount of money as what you put in 13 years ago. By contrast, 13 years ago, 12, 13 years ago, at the depth of the global financial crisis in 2008, 2007, if you bought US stocks at that point, over the next 12 years, the US stock market was one of the best performing markets in the world. So right now, of course, one of the reasons that I'm getting a lot of interest in US stocks is just because anyone who looks over the past few years sees that the US stock market has been doing very well recently. And a lot of that, understandably, is due to the dominance of the 5 largest US companies, Facebook, Apple, Microsoft, Google, and Amazon, which now represent over 20% of the US stock market, and together that means over 10% of the world stock market. Now, whether or not you believe that those are necessarily going to continue, the fact is if you buy shares of Apple or if you buy shares of Facebook, that is a US company, and you may not face immediate tax consequences for it, but there are tax traps that we'll be talking about more later. Now, in the lower left-hand corner is a chart of US listed real estate investment trusts versus a global portfolio of real estate investment trusts outside the US. This is only a 10-year history because these funds were only launched about 10 years ago, but in these past 10 years, similar to what we've seen in stocks, US real estate investment trusts have outperformed non-US real estate investment trusts. Now, on the right-hand side, the third chart over there is the 10-year government bond spreads that I pulled from the Financial Times. Now, I've recently updated this, and now there are a few foreign bond markets, few foreign government bonds that yield more than U.S. government bonds. But when I ran this earlier this year, the 10-year U.S. government bond yield was higher than any other government bond yield. And just in general, if you compare buying a 10-year German government bond or Japanese government bond whose yields are negative, you are guaranteed to get back less money in 10 years if you lend to those governments, versus the US, where we're still not really worried about the US defaulting. We at least know that if we lend $1 million to the US government, I'm not going to get a huge return, but at least I'm going to not get a negative return on a guaranteed government bond. We also see, of course, U.S. Treasuries tend to go up when other assets go down. So there's a lot of times interest in owning U.S. Treasuries just simply as insurance or as a counterweight to just about any other asset that you own. Reason number 2, so I was mentioning purely financial and opportunity reasons to invest in the U.S., but another reason not to be overlooked is just privacy. So in this age of FATCA and CRS, and I'll mention a little bit later what FATCA and CRS are, one reason that many clients, many investors from around the world want to open accounts in the US and own US assets is that the US doesn't share information with other governments. If you want financial privacy, Delaware, South Dakota are going to be some of the best places to get it. And the snapshot that I've included here was a picture of Meghan Markle, who of course, was an American citizen and married into the British royal family. And there have been lots of articles about what Meghan Markle's complicated tax situation would become if, let's say, the Queen gifts her a tiara. How exactly would that be reported and accounted for in U.S. taxes? But I believe it says something that in terms of her own family planning for setting up her corporate interests, her investment, she chose the U.S. state of Delaware, mostly, again, for financial privacy reasons. So what is there to know about the difference between non-US accounts and US accounts? So I mentioned earlier FATCA. FATCA was passed within the past 10 years. It stands for the Foreign Account Tax Compliance Act. What that means is that if you have a bank account anywhere in the world outside the US, if you have a bank account here in Hong Kong, a bank account in Singapore, a bank account in Belgium, Australia, those banks have now all been required by the US government to spy on their own customers, to basically tell the IRS whether they're doing business with any Americans. Now, what that means is that there's information sharing agreements where that information has to get sent back to the US. But right now, most of that information is pretty much going one way. The US is going to banks in Hong Kong and say, you have to tell us about any Americans who are your clients. But the US is not going to be reporting, in reverse on any on accounts that go back the other way. You may have also heard the OECD's response to FATCA, which is CRS. This is basically a response of other developed countries, European countries, Australia, for example, who want to report on each other. They say, hey, what the US is doing to avoid our residents, our citizens stashing away cash and doing business in foreign bank accounts to try and hide money from the IRS, that's a pretty good idea. Why don't we share information with each other in order to prevent tax avoidance for, say, an Australian resident who has an account in Hong Kong, or a British resident who has an offshore account. Again, a measure just to prevent tax avoidance. But what's important here is the US is not a signatory to CRS. So you have, in a way, two different competing regimes for governments reporting information to each other. Now, the other thing I've noticed with non-US accounts, and that includes bank accounts, brokerage accounts, is fees are generally higher and the level of service is generally poorer. When I go into my local HSBC branch here in Hong Kong, I often joke that HSBC stands for how simple becomes complicated. I went off to my company secretary this afternoon, and I wrote them a paper check because they would have charged me a fairly sizable fee if I wanted to pay them electronically. If you ask me, that's absolute BS, but that's the fact here, and that's what I'm dealing with when I deal with Hong Kong banks. I will also say, if you ever wanted to try and open an account in Hong Kong, especially a company bank account or a fund bank account, they're generally slower and they take a lot longer than what we're used to in the US. Now, by comparison, if you have an investment account in the US, a bank account in the US, first of all, there's no FATCA because it's not a foreign account. It's a US account as far as the IRS is concerned. And there's also no CRS. The US is not a signatory to CRS. So in a way, that's what I mean when I talk about financial privacy. You also will enjoy some of the best and cheapest financial services in the world. So when I say that in Hong Kong, I'm lucky if I can open an account in days. Sometimes it will take me weeks or even months for a corporate account. In the US, I can open an account in minutes, sometimes even in seconds. And there are various reasons for that. Again, not having to worry about FATCA and CRS, but also it's a very large and very well-developed market with lots of investment in technology and also a lot of competition. So I'm very used to very low fees on funds, very competitive rates from banks, and they're all competing with each other to provide good services. Now, part of what I say is don't think that financial privacy means that it's a haven for money laundering. I say the reason they can do this is that the NSA and the IRS already know everything about you anyway. If you set foot on US soil, if you do anything in the world in US dollars, chances are the NSA has some track of what you're doing. I will also say that one big disadvantage of US accounts is whenever I've dealt with even large US brokers, large US institutions, and I kid you not, they don't seem to know what foreign currencies are. I seriously dealt with one fairly large brokerage firm where I asked if they would support transfers in Hong Kong dollars or in Singapore dollars. And they said, no, sir, we can only take American dollars. We cannot support foreign dollars. So any transfers in have to be made in US dollars, no foreign dollars. And I still find it so funny that they use the term US dollars versus foreign dollars, but that does give you an idea of how domestically and US focused US financial services firms are, as much as that means. So I mentioned that this presentation is for non-US persons, so I think it's important for me to take a moment and define what is a US person. So here is a screenshot from the IRS, and just in general, you can read it yourself, but really what it means is a citizen or resident of the United States. That means if you have a passport or a green card, you're a US person. If you are a resident, so not just a permanent resident, but if you live in the United States, you file taxes and you are taxed as a US person. But also non-human persons, so partnerships, corporations, trusts that are domiciled in the US will be considered US persons for tax purposes. Now, what that means is who is not a US person? A non-resident alien. What I like the term alien a lot. A non-resident alien is a non-American who doesn't live in the US. And there's a tax form, 1040-NR, the 1040 form for non-resident aliens. That is exactly the tax form you're talking about. If you go and you buy a piece of real estate or you have income from the US and you want to file a US tax return, you're a non-resident alien. You have US source income and you're filing a tax return for that. The same thing for a foreign corporation, foreign partnership, foreign trust. Anything that's not a US person is a foreign person. So you also need to be aware of physical presence thresholds and other tests where, let's say, even if you're a non-US citizen, you go spend a lot of time in the US, there are certain things that will trigger it. And as I said, I don't give tax advice, but this will give you an idea of whether or not you're a US person for tax purposes. Now, what are the taxes you need to be aware of when you're a non-US person? So first of all, if you're a non-US person, you're only going to be worried about US taxes on income from US sources. So your US stocks, your US real estate, your US businesses and private equity, those are all going to be subject to US tax because it's US source income. The withholding on those can be generally around or up to 30%, depending on what type of income it is, depending on any treaties that may be in effect. And we're going to be talking about those. There are also some exceptions and exemptions from withholding and from those taxes, which we'll also talk about. So I mentioned income tax. That's what you pay every single year on income from US source. But the other big tax trap I want to make sure is clear here, because it catches a lot of people by surprise, is the estate tax on US situs assets. So that means, for example, if you have an investment property in the US that's worth, let's say, even $100,000, the amount that's over 60,000 US dollars upon your death, when it goes through probate and it has to pass to the next of kin, the IRS is going to say, well, what is the value of your estate? What is the value of the US assets that are passing from the deceased non-resident alien to the next of kin? And any amount of US situs assets above 60,000 US dollars could potentially be subject to US estate tax. And I say could because there are cases where it might be a low rate or you might be able to get higher limits. I'm not going to go into those in detail, but that 60,000 number is one that I keep a very, very close eye on, because in general, when I manage a portfolio of US stocks for a non-US client, I'm very, very careful with that US number, because I always worry about if my client were to suddenly pass away and they had $200,000 of US stocks and they had a big US estate tax bill, I would want to make sure I prevented it. One US estate tax lawyer that I work with had said, only half jokingly, well, the thing you need to do is your client should call you from the, when they're on the way to the hospital and say, sell all of my US assets because I'm going to the hospital. There's another step on that, but like I said, I think she was only half joking on that. Now, the third type of tax that you might be familiar with is capital gains taxes. But the one important thing is that many times foreigners, let's say if you wanted to buy shares of Amazon, Amazon doesn't pay a dividend. So if you just simply buy and sell shares of Amazon in your account, you're not dying with it, there's no dividend being paid. Under current law and under the current setup, the US does not have any withholding or does not capture any taxes from capital gains made by foreign investors. So one of the strategies, is, as you might guess if we peek a little bit later on, is to try and see if we can turn income into capital gains, and in doing so, avoid any withholding or ultimately any taxes. Now, I say capital gains, I also will point out something called FIRPTA, which specifically affects investors, non-resident aliens, foreigners investing in US real estate. So that's something to watch out for if you invest in US real estate. Now, what do I want to contrast this with? By my accent, you can tell I am a US person, but as a US person, what taxes do I have to pay that foreigners don't have to pay, or vice versa? Now, US persons, if you meet that earlier condition, you're taxed on your worldwide income, your worldwide capital gains, and your worldwide estate when you pass away. Now, every time people hear my accent, is like, oh, are you American? Worldwide tax. Oh my gosh, is that such a bad thing? Well, from my webinar I discussed last week, it's not necessarily such a bad thing. There are ways of managing it. One of the biggest differences, of course, is that we are taxed on our worldwide estates when we pass away, but our exemption is $11.5 million. So depending on the how high and ultra high net worth individual you are, if you're well below that 11.5 million, you may not necessarily be worried about that, and you may be trying to get as much into that as you can to take advantage of that estate tax exemption. And there are various reasons for that we covered in my webinar for US taxpayers. I should also mention that even though there are all these taxes, there are also lots and lots of tax shelters. And I mentioned that if you're a non-resident alien with a 401k plan or IRA, I will be addressing at the end of this webinar some of the strategies that you can do about that. But as an American, we have lots and lots of tax shelters at our disposal. We have IRA accounts, we have 401k plans, we have 529s for college savings, we have HSAs for health savings plans, we can set up 501c3 donor advised funds and charitable remainder trusts, and you name it, that whole alphabet soup of ways to shelter our investments from US tax is something I've spent a lot of time studying. And that's why even when someone says I'm thinking about giving up my US citizenship or thinking of giving up my green card, I do point out, well, if it's just for tax reasons, let's first go through all the other options you might want to consider first. So it is an election plus or minus, and I mention this because some non-resident aliens I speak to are considering eventually immigrating to the US, and there is some tax planning that goes into that as well. So I mentioned earlier for real estate investors, foreign investors do like buying US real estate, but if they do it directly or directly through a foreign holding company, there is something called FIRPTA. And I forget exactly the acronym. I believe it stands for Foreign Interest in Real Property Transfers Act or something like that. What FIRPTA is basically meant to do is they realize lots of foreigners go to the US, they buy property, the property appreciates, and then when they sell it, they want to make sure that they capture some of that tax. And the way that they do it is that any American, or basically really anyone who buys property from a foreigner. So let's say I'm an American and I want to buy a house, and you, the foreign investor, bought this house for $500,000. You want to sell it to me for $1 million a few years later. When I buy it from you, I am required to withhold 15% of the gross transferred value. So for $1 million, I'd have to withhold $150,000 and send it to the IRS if I'm buying it from a non-US person. And the reason for that is the IRS basically wants to capture this withholding and make sure you file a tax return to try and get some of it back. It was a way of trying to capture more tax from foreigners who, again, like investing in US real estate. You may ask how many buyers do that. Of course, in the US, many buyers buy real estate through real estate agents. Real estate agents are very aware of FIRPTA because for many of them, many of their best clients are non-US investors in US real estate. So if you've bought property in the US or if you've sold real estate in the US, FIRPTA is probably an acronym you're already familiar with. And I'm going to talk about some solutions later on. So I mentioned briefly earlier on that the US estate tax, also known as the death tax, triggers for non-resident aliens on US situs assets above $60,000 of US situs assets. And the rate of that can be as high as 40% on the amount of US situs assets over $1 million. So the US estate tax lawyer I mentioned earlier, who was joking about selling the client's stocks when they called me on the way to the hospital, was recently dealing with a case where a client died with a fair amount of assets and was having to pay over $1 million in US estate taxes. I do hope that any of you who might have been in that situation can take a few steps to prevent it after listening to this webinar. Now, first of all, I wanted to define what is a US situs asset by first of all saying what is not a US situs asset. Now, obviously, anything that's outside of the US should not be a US situs asset. If you live in Hong Kong and you have a property here in Hong Kong, that should not be considered a US situs asset for US tax purposes, obviously. So first of all, it's something that sits in the US. Now, also, what may surprise some people is U.S. bank deposits, believe it or not, are not considered U.S. situs assets for U.S. estate tax purposes, but brokerage deposits are. So the money, the cash that you have in your JP Morgan Chase account in the US, your Bank of America account, is not a US situs asset and will not account to that $60,000. But the money that you have in your Schwab account or your Fidelity account or your Robinhood account, that is all a US situs asset. So when I was told that you should sell that person's stock when they're on the way to the hospital, I then need to do one of two things. I then either need to transfer it to their bank or I can buy bonds. That's the other strange thing is many U.S. bonds, U.S. Treasury Agency and corporate bonds are also considered non-U.S. situs assets. And the reason for this, again, might be quite clear. Americans love to borrow money. And not a lot of Americans like to have extra money or save money to lend. Fortunately, lots of foreigners love to save money and they love to invest in US dollars. So if we have foreigners who love to lend money to Americans, we want to make sure that to make it as easy as possible for foreigners to lend money to the US government, to US corporations, without really snagging them with the tax trap. So I also should mention life insurance proceeds. I'm not sure if you can see it at the bottom of the screen there. If you own a US life insurance policy, that's also not considered a US situs asset from what I've read. Now, what is a US situs asset? Well, real estate in the US, if you own a house, a property, a commercial building, that's obviously a US situs asset. It's sitting in the US. Also, don't forget tangible personal property. And this may sound a little bit silly at times, but if you have, let's say, jewelry in a vault, gold bars or, jewelry, and if that's worth more than $60,000 US, that will count towards your estate. When it's sitting in the US, it will have to go through a US probate court, and they will check with the IRS and make sure that estate taxes have been paid. I also mentioned earlier, for example, shares of Amazon or shares of Google, shares of Starbucks, shares in US private companies, public or private, shares of US funds, public or private, are considered US situs assets. Now, I mentioned here there is a discount when you have a minority interest. That's a little bit of a technical matter, which I won't get into too much detail here. But what I want to mention here as well with US funds, if, let's say, for example, you wanted to invest in the Chinese stock market, and you found that China funds listed in the US are actually very well priced, very competitive, very well managed, good managers. Those are US domiciled funds, and those are now US situs assets. Even though those funds are investing abroad, you have now entered the US tax net by buying US funds. Also, I'll mention solutions for that. Now, also, obviously, IRA accounts, 401k plans, any US pension plan would also be considered in whole a US situs asset. So let me start talking about solutions. I've talked a lot about the problems, the different taxes and different ways to get snagged in the US tax net. So what can you do to fix it? I say solution number one, the easiest one, is to just fake it. So this may sound a little bit sinister, but I'm actually quite serious. Rather than owning the assets that you wanted to buy, so let's say rather than buying shares of Amazon, you could get access to the shares of Amazon via derivatives. So maybe buy single stock futures contracts, or maybe buy a call option and sell a put option. So there are different synthetic ways of getting the same exposure. And the example I'm going to use here is, let's say you wanted to buy the S&P 500 stock index. So one option would be if you bought the US fund SPY, the largest and most liquid ETF in the world. It's a US situs asset. It's going to count towards your 60,000, and any dividends paid from SPY are going to be subject to that 30% withholding tax. So if you wanted to invest, say, $150,000 in the S&P 500, the dividends paid to you, roughly $3,000 a year, $1,000 a year of that would be paid in withholding taxes, and as mentioned, it would be a US situs asset. If by contrast you simply bought an E-mini futures contract, gives you the exact same exposure to the exact same index, but it's a futures contract which is not actually owning stocks. You're basically buying a promise to deliver what the index is. Meanwhile, you take that $150,000 for margin and you use it to buy treasury bills, which, as I mentioned, the interest is not going to be subject to withholding tax, and it's not a US situs asset for estate tax purposes. You're going to get pretty much the same gross return, except you're going to do much better without the withholding tax and without the estate tax. If anything I said sounded like Greek because you're not familiar with how to trade futures, that's something that, of course, we can cover in a different session. But I wanted to mention that this is one way of just owning the same thing in a different way in order to get more tax-effective exposure. Now, this is one major driver of structured notes and synthetics, also known as swap-based funds overseas. You will see lots of funds domiciled in Europe that provide synthetic exposure to the US as opposed to simply buying US shares. Now, I should point out that since 2017, IRS Section 871M has tried to close this loophole somewhat. Basically, if you use a derivative that really tries to directly circumvent dividend taxes, they're going to clamp down on that and try and find the ultimate destination of that derivative and apply withholding taxes appropriately. But that said, when I talk about the futures contract or when I talk about standardized options, 871M generally won't affect most of those cases there. So another thing that I want to mention too, because we're talking about futures contracts, and I mentioned earlier, let's say in the case of Amazon, well, most of your return in Amazon would be in the form of capital gains rather than through dividends. Well, if you are a stock, like let's say you're Apple, and you realize a lot of your investors, an increasing share of your investors are foreign investors, how can you return all those cash profits to investors without triggering massive withholding taxes? And a controversial topic you may have heard of lately is, one word, buybacks. So what is a buyback? A buyback is simply when a company takes some of its cash profits and rather than paying it out as a dividend, simply uses it to buy back its own shares. In doing so, it reduces the number of shares outstanding, it increases the earnings per share, and it pushes up the stock price in the process. Over time, buybacks basically will mean that you own a share, you own a larger share of the company, and that share will have more profits to it. And so it will be one way for you to realize profits on your investment through capital gains rather than through dividends. It is, in a way, the biggest remaining loophole for investors who want to transfer dividends into capital gains. What this chart shows is it shows that since the 1990s, in this case, dividends really started taking off again in the 1980s. Dividends have actually become a lower percentage of the total return of the S&P than what has been driven by buybacks. And the chart in the lower right-hand corner shows you how the blue line is the S&P 500 index. The red line is the return of investing in a select dividend stock portfolio, while the yellow line shows you the buyback portfolio. So over the past 15 years in this case, buying stocks that buy back their own shares has outperformed buying stocks that pay higher dividends. I actually don't believe that that's going to continue, but that, of course, is an investment decision, and that's something we can go down in a lot more detail. So solution number two, I mentioned solution number one is to fake your ownership. The solution number two to the estate tax specifically is to own your assets via an immortal wrapper. And immortal, what I mean, is something that doesn't die. This goes back to kind of a simple principle in taxation, is that if you find something that is taxable, the way of saving that tax is to not do that thing. So if you see income taxes and you don't want to pay income taxes, the simple solution to not pay income taxes is to not have income, or to have income, things that look like income, but they are classified in other ways. The same exact thing with death taxes. The simplest way to not pay death taxes is to not die. And the way you do that is if you want to invest in US situs assets, own it through a company or through another structure that won't die. So let's say, for example, you live in Hong Kong and you have maybe a Hong Kong holding company, a company that owns your property, or you do other business with it. If you own your US stocks in a Hong Kong company, your Hong Kong company is not going to die. If you die in Hong Kong and it goes through probate, you never have to get anything from the IRS saying that estate taxes need to be paid because a shareholder has been changed. So that's really the simplest solution to sidestepping US estate taxes, is to just simply own it in a structure that won't die. Now that solves estate taxes, but it won't solve your withholding tax, because a Hong Kong company is still a foreigner. So it will be subject to the same withholding as a foreign individual would be. Now, I mentioned a Hong Kong company as an example, but there are several jurisdictions you might choose from, including the BVI, Cayman, Ireland, really just depending on what you're looking for. Solution 2B, and I mentioned this as an extension to solution 2, is to use an immortal wrapper that has a favorable treaty. I mentioned Ireland at the end of my last list because I want to give the example of earlier, you're a Hong Kong-based investor and you wanted to buy US stock, 30% of that dividend from that stock will be withheld. If you buy pretty much the same portfolio, so I mentioned here earlier the S&P 500, you buy $150,000 of the S&P 500, pays a $3,000 dividend, 1/3 of that gets withheld, so you pay $1,000 in withholding taxes. If you bought your S&P 500 fund through Ireland, through a fund domiciled in Ireland, Ireland has a tax treaty with the United States. Basically says that 0% withholding on interest, 15% withholding on dividends, only $500 of dividends of withholding tax instead of $1,000 would be withheld by the US when sending that dividend to Ireland. Ireland would then send all of that dividend to you. Even net of fees, you would usually come out ahead. So my solution in that case is, if you've bought US ETFs or US funds and you're a non-US person, see if you can find an Irish or Luxembourg equivalent. And yes, that's a lot of what I do in our firm, is helping clients find Irish and Luxembourg and other offshore equivalents of US funds that at the end of the day will mean more money in their pocket. Now, I will highlight there that Ireland currently has no withholding tax for dividends coming out of their funds to investors in Hong Kong. Now, Ireland may seem like a slightly random country to some people, but I wanted to show this ranking table of who are the top holders of US treasuries around the world. Now, you may have often heard Japan and China will often jockey for that top position, each holding over $1 trillion of US treasuries, or some of the US's biggest creditors. Next on the list is UK and Brazil. But then what might surprise you is Ireland and Luxembourg. How on earth are Ireland and Luxembourg number 5 and number 6 in the holders of US treasuries? I can tell you it's not because the Irish are famous for saving large portions of their savings with a massive domestic money market. A lot of those US treasury holdings coming from Ireland and Luxembourg are simply reserves and fund holdings held by funds domiciled in Ireland, where a lot of that money is ultimately coming from Chinese or other Asian investors. So that's what I wanted to highlight here when I show the significance of Ireland and Luxembourg, and then later Hong Kong, Switzerland, Cayman Islands, in being some of the top holders of U.S. Treasuries. Now, a few notes about tax treaties. I am based in Hong Kong. The U.S. does not have a tax treaty with Hong Kong, but it does have one with mainland China. Hong Kong has separate tax treaties with the UK, Canada, and a few other jurisdictions, but I won't go into that in too much detail. Tax treaties can be a lot of fun to read if you're interested in that, and they can be very, very detailed and cover, for example, interest, dividends, royalties, pensions, retirement plans in either more detail or less detail. And there can often be separate treaties covering estate and inheritance taxes or other specific types of income. So for example, the US-Singapore Treaty, it does not have any treaty that covers dividends or interest, things that would affect us. It has a very limited treaty only covering aircraft and shipping income, which for most people I talk to really doesn't help. Now, tax authorities are also very, very wary of treaty shopping. So let's say, for example, if you wanted to go set up your own private Irish company just for trying to, benefit from the treaty, you might be subject to substantial presence rules and other rules that might say, hey, wait a minute, you really aren't Irish, you're really just trying to treaty shop here. They might disallow that withholding amount. But notice that a fund in Ireland was originally set up as a UCITS fund. It was really meant for Europeans. So even though there are a lot of Asian buyers from a lot of different countries, the fact that they have that diverse pool of investors is what gives them that cover for Ireland's substantial presence, not to mention having the fund manager, custodian, and other services provided within Ireland. That's ultimately what Ireland wants. Solution number 3, gifts and foreign spouses. And I'll go through this a little bit quickly. And this really covers if you have an American married to a non-American, what are some of the things that you can do here? So if you are an American married to a non-American, I can gift my as an American can gift my non-American spouse $157,000 US in 2020. That was up from $155,000 in 2019. And in addition to that, I can give $15,000 per person to anyone else I want. So as an estate planning strategy, that's one way Americans can get, especially non-US assets outside of their estate, below that 11 million. The best gifts to give are appreciated low basis income paying foreign assets. Now there's a lot there. Any of those things will do, but if you have a choice of who to give what to give from your $15,000, those would be the best place to start. And I would also say U.S. Treasury agency corporate bonds. If I'm giving to my foreign spouse and I've got U.S. assets, I want to obviously give something that's not going to trigger estate taxes to the person I'm giving it to. Now, from a non-U.S. person to U.S. person, what may or may not surprise you, there's no limit to the amount of gifts a non-U.S. person can give to a U.S. person, and there's no transfer tax. So a very, very generous foreigner could give me a gift of $10 million, and there's no transfer tax on that. The U.S. likes that because it enters the U.S. tax net, and they're going to start charging me tax on the interest from my investing that and on my estate when it goes over the 11 million and so forth. So the IRS wants this because they want gifts to Americans that are going to get it in the U.S. tax net. The obvious case here, you can think of grandparents in China giving gifts to their grandchildren in the U.S. who may be U.S. citizens. The IRS, of course, would want that. Now, for large gifts, and that means $100,000 from an individual or a state, or $16,000 from a corporation or a partnership, there's a filing that you need to make just to let the IRS know, hey, I received a big gift. That's Form 3520. But again, ask your tax advisor. I do not give tax advice. So one solution for withholding or a low estate tax exclusion, is to look at this gifting. So let's say, for example, you have the grandparent who's bought a U.S. property. Eventually, they, let's say, want to give it to their kids. They don't want to be over the $60,000 threshold when they pass away. But the thing to really be careful for here is if you make a gift, I'm giving you not just the asset, but I'm also giving you the cost basis. If the grandparents bought the house for $300,000 many years ago, it's now worth $1 million. If they give it to the kids, the kids will get it with that $300,000 basis. When the kids sell it, they will have a huge capital gains tax to worry about. So be very, very careful about that. You might want to look at other ways, like let's say, for example, having the parents sell the house to their kids for $1 million for fair price and do solutions like that. Again, that's a planning decisions you might want to discuss with your tax advisor, but I want to make sure that I've at least highlighted the danger of giving low cost basis gifts to American persons. That's something I also, again, I look at whenever we talk about foreigners who are looking to migrate to the US. If you're looking to migrate to the US and you bought a lot of 10-cent stock back when it was a tenth of what it is now, you might want to make sure you reset those cost bases before you set foot on US soil. So I'm mentioning this on the solution of number 4 of become or create a US person. So I mentioned some of the tax challenges of being a foreigner investing in the US. If you have enough interest in investing in the US, you might either want to become American or, I say this, create an American. So becoming an American means immigrating to the US, becoming a US citizen, getting a US green card, going and living in the US and being taxed as a resident. And there are reasons why you might want to do that, especially if you are making private investments in the US and private businesses in real estate. You're going to want to spend time there to make and enjoy those investments. Now, on the other hand, if you're just buying, let's say, US stocks and bonds or private equity, you don't really want to become American. You can create an American. And by this, I mean you create a US company, specifically creating a US C Corp. A US C Corp is a taxable entity that files its own tax return. So you're going to file, instead of a 1040, the Form 1120, a US corporate tax return. Now, this has become a lot more appealing since the 2017 Tax Cuts and Jobs Act, the TCJA. Basically, it means the C Corp is a good blocker. When the corporate tax rate was 35%, it wasn't as appealing as now that it's 21%. And remember, 70% of the dividends received to a C Corp are also exempt from tax. So your net effective rate in a C Corp is a lot lower than it would be if you were subject to any kind of withholding. And so in a C Corp, once you hold it and you keep it and you accumulate it there, you can accumulate it and you don't ever have to dissolve that company, or you could liquidate that company well later on. So it works quite well as a tax blocker for domestic investments. But remember, a US C Corp is a US situs asset. So if you use this, for example, for holding your treasury bills, your US treasury bills would have been fine, but if you die with this company and it's worth $1 million, it'll be subject to US estate tax unless you hold it in an immortal foreign wrapper. I will also mention, if you're charitably inclined and you're looking for a jurisdiction for setting up a foundation or a charitable trust, the US is also one of the top places to do that, because you will get the tax exemption under 501c3, as well as all the benefits and protections of US laws. So I was mentioning earlier the benefits of or different ways you would own a US situs asset. So method number 1 is just the direct method. This is what we talked about earlier. You're a non-US individual, you own the US situs asset directly, and the scenario we mentioned is dividends that come to you are going to be subject to the withholding. Any amount over $60,000 is going to be subject to the US estate tax. So the real advantage here is that it's simple. The real disadvantage is it can be very expensive from a withholding tax, estate tax, and other point of view. Method number 2 is to use a foreign hold company. That was the example I mentioned earlier with a Hong Kong company. I put here BVI in quotes because just about everyone I know in Hong Kong has a BVI company. You own the BVI company. The BVI company owns the US situs asset. As mentioned, this will solve your estate tax problem, be it not your withholding tax problem, but it's just one layer in between. Method number 3 is you create the US company. In this case, I'm saying a US LLC. A US LLC is tax transparent, but it will provide you a US address. It will let you create a US account. The thing to note there is you will really have not solved any of the withholding or estate tax issues. The real thing, what you're providing for here, is you're blocking liability. The reason that foreign investors set up US LLCs is because, let's say you buy 5 houses, you put each one in an LLC, someone slips and falls in one of them and sues you, you want that LLC to block you from a liability point of view. It doesn't really help you from a tax point of view, it's really more of a legal and administrative point of view. Method number 4, as I mentioned, was the C Corp. This slide looks almost exactly like the one before, where the LLC is a blocker, but here, instead of just blocking liability, it will also file the tax return and mean that there's no withholding tax issue from the US to the non-US individual. Now, as I mentioned, that C Corp is a US situs asset. So as you probably guessed it, putting all these pieces together, we get to solution number 5, which is the most complicated one. And that's the 2-tier solution. That's the one where a non-US individual sets up the BVI company. The BVI company owns the onshore US hold company, and that US hold company owns the US situs asset. Yes, this looks like a very complex solution, 2 layers, 2 tiers. You're not going to do this just to own $100,000 of Amazon stock in your Schwab account, but you might do this if you have a lot of US properties or a lot of other assets, and your US investments are a significant part of your overall estate plan. Again, if you're working with a good estate planner, they're going to help you put all these pieces together. I want to mention something about trusts, because when we talk about estate planning, trusts will very often come up. Now, Americans, and this is one thing I noticed, Americans will often have these things called revocable living trusts. These are very simple instruments, and they're there just to avoid probate and plan for incapacity. There is no tax consequence or tax benefit at all for a revocable living trust. But I noticed in the US, most Americans I know had them. When I came out here to Hong Kong, most people out here don't have them. Most people out here either rely on their wills or they rely on intestacy laws. The type of trust many of you listening here might be interested in, especially if you have kids or other relatives who are in the US, is something called a foreign grantor trust. So I could do a whole separate presentation specifically on foreign grantor trusts, but the thing to remember is that they're basically revocable living trusts set up with where your initial beneficiary is only the grantor and spouse. So it's basically treated as though you are owning the asset directly, but it's really set up so that you can seamlessly handle succession to ultimately US beneficiaries. And again, I mentioned there's a whole other set of topics we can cover on foreign grantor trust later. There's another type of trust called a domestic asset protection trust, which again would deserve its own webinar. This is really set up to provide the asset protection that I mentioned. So for example, if you get sued by one of your tenants, or if you're a surgeon and you're worried about getting sued by one of your patients, you would put assets in these so that you have some assets that are protected from what are often called predators, creditors, X's. And there are a few major jurisdictions for these: South Dakota, Delaware. Now, these are usually also transparent as far as tax purposes go. So the irrevocable part is really meant for asset protection. Now, trusts do need to be irrevocable to have any tax consequence, and I put here an exception unless they are an ERISA trust. That ERISA, just think of, let's say, a 401k plan or defined benefit pension plan. That again is a whole other area, but I'm running through this in round robin just to get you to think about all of these solutions. I mentioned earlier the US is a top jurisdiction for charitable trusts and foundations. So if you are looking to set one of those up as part of your long-term family planning, dynasty estate planning, do consider the US as a jurisdiction. Now, I mentioned IRAs, 401ks, and other US pensions for non-US persons. I have very many cases like this where non-American has gone and worked in the US for a while, and they have one of these back in the US. My webinar last week talked about if you're an American and you have one of these, what to do with them. This is for non-Americans. So non-American or former American, so maybe someone who had a green card or was a US citizen and they gave up their citizenship, but they still have an account, they still have an IRA in the US, they will have all of these from their years of working in the US. As a non-resident alien, these plans will face withholding rates of up to 30% or whatever the treaty rate is when you withdraw them. So when you withdraw money from your IRA, the Schwab or Fidelity, Vanguard, whoever you withdraw it from is going to say, okay, well, wait, where are you resident? If you're a non-resident, they're going to have withholding on the withdrawal. And typically, if you're below the age of 59 and a half, there's also a 10% early withdrawal penalty. And so that's what happens if you withdraw it too soon. And then, of course, if you are left with any of it when you die over 60,000, it could also be subject to estate tax because it's always a U.S. situs asset. So initially, you might look at these like, oh my God, that's terrible. I got this money kind of trapped there. You know, how do I get it out with any reasonable rate? Well, usually it means you're going to have to file a U.S. tax return, and we're going to have some planning involved with how to get it out intelligently and not pay the maximum rate. So some of your options, which I'll go into more detail later, you can leave it where it is, or you can transfer, consolidate it into a single IRA account, and then plan your withdrawal strategy. So I will note the bright side of this is if you were going to make US investments anyway, all of those company structures I was mentioning earlier, having a US C Corp, for example, well, guess what? If you've got an IRA or a 401k plan in the US with $100,000 in it, you already have the most powerful tax shelter in the world for making any of your US investments. So if you want to, for example, transfer it over to a self-directed IRA and make all of your US real estate investments in that, and now suddenly you don't have FIRPTA to worry about, you don't have any tax withholding to worry about, all of your cash flows coming through are completely tax deferred until you withdraw, you might want to hold on to that just to do your US investments until you work out your withdrawal strategy. So let's talk a little bit about the withdrawal strategy. As I mentioned, with exceptions, and I believe they've made the exception this year, there's usually a 10% penalty if you make withdrawals before the age of 59 and a half. Now, as a non-resident alien, you should consider treaty withholding tax rates, and I put more details of this on the next slide. I also want to warn you that if you have a Roth IRA or Roth 401k, or if you've made a Roth conversion, depending on your country of residence, sometimes your country of residence will tax those withdrawals even if they're a Roth. So that will not help you if you've done a Roth IRA thinking it'll be tax-free in the future. Maybe you've even filed the tax return and gotten back all your tax, any withholding, but then you find that the country you live in will tax it even if it's a Roth. Those are all things that you need to consider when planning your long-term IRA withdrawal strategy. And as I mentioned, you should also be aware of the estate tax. Now, generally, the estate tax is something you worry about as you approach death, but overall, we say, well, before 59 and a half, you got the 10% penalty. So if you die before 59 and a half, that could be a problem. But generally, before 59 and a half, that's when many of us have life insurance policies. And so one strategy is to say, well, up until I'm 59 and a half, I'm still working, I'm still earning money, I'll have a life insurance policy in effect until, say, maybe about 60. If I die before then, my life insurance policy will pay out and that'll cover the estate taxes. If I don't, then the 10% penalty won't apply. I'll be able to start planning those withdrawals based on where I live at the time and based on what my tax situation is then. So this was one slide that I presented in my webinar last week, because as I mentioned, if you're a non-resident alien, your withholding tax will depend on your country of residence and any treaty that might be in place to say how do withdrawals from IRAs or how do withdrawals from pensions get taxed for, let's say, Australian residents or Belgian residents, Chinese residents, and so forth like that. The details will differ, let's say, from Social Security versus an IRA versus a 401k versus a defined benefit plan. So please do consult with a tax advisor who's familiar with the treaty, with the country with where you live. Now, as I mentioned, here in Hong Kong, for example, we have no treaty, but the good news is here in Hong Kong, there's no tax on withdrawals from foreign pension plans. So that's the thing to consider. So a summary of some of the withdrawal strategies you might consider. Strategy 1 is just take a lump sum now, pay any of the penalties of the taxes. Strategy 2 is take a lump sum withdrawal after the age of 59 and a half, so you avoid that penalty, using life insurance before then if you need to. Another strategy is to take periodic withdrawals over time. No one says you need to take out all of your IRA at once. We could look at a strategy where, let's say, you have $200,000 in an IRA, and depending on your tax situation, maybe you take out $20,000 over a year over 15 years, and that will allow some tax-deferred growth in the meantime. And then another option, of course, is that if the Roth works for you, if your own country doesn't tax the Roth and you can ultimately get it tax-free when you take it out, or even better yet, if you were planning to, let's say, immigrate to the US later on, a Roth conversion might make sense, and then you would plan to withdraw it in your final years, obviously knowing that you would do that. Half joking again to say, when you're on your way to the hospital, call me and let's make sure we withdraw your Roth and buy some bonds with it. So thanks again for attending. I know that was a lot to cover here. I want to leave this slide up with my contact details, WeChat QR code, and so forth like that. And make sure I get some time to get to the questions. I've noticed there are already quite a few of them, so let me try and get to them in order. So starting with the first one. Okay, so question, firms such as Vanguard sell both Hong Kong and US versions of their ETFs. For example, the S&P 500 VFinex, and in Hong Kong, we have a Vanguard S&P 500 by the ticker 3140. Each one has the same holdings, but different expense ratios and presumably tax treatment. For Hong Kong citizens, non-US persons, which one should investors buy? So I hope it was clear for here. And again, this is not personal investment advice, but just in general, Hong Kong residents should not buy US ETFs. I mean, obviously for short-term trading, they're liquid and you don't have to worry about the capital gains taxes. But as I mentioned, you have the withholding taxes and they're considered US situs assets. So general rule, I say non-US persons shouldn't really be buying US funds unless they have a good tax treaty in place. On the other hand, the Vanguard S&P 500 fund listed in Hong Kong is set up as a domestic fund. So it's also going to have the 30% withholding when that dividend goes from the US to the Hong Kong fund. That's the way that Vanguard chose to set it up. So that's going to shelter you from the estate tax, but it's not really going to provide you much of an advantage from the withholding tax, and does have a higher expense ratio. So that's something to weigh there. My recommendation for most clients there is to look at the funds domiciled in Ireland or Luxembourg that provide exposure to the S&P 500. They will have the 15% withholding rate, relatively good liquidity, and relatively competitive cost. Slightly higher than the US, but net worth it. There is also a UCITS fund, I believe it's Luxembourg domiciled, traded here on the Hong Kong Stock Exchange that tracks the S&P 500. I will not give the ticker for it here on the webinar, but it will be pretty easy to find if you want to go and look for UCITS S&P 500 listed on the Hong Kong Stock Exchange. Okay, next question is, does this include U.S. assets which has non-U.S. U.S. ETFs which has non-U.S. assets? Yes, absolutely. If you buy, for example, EWS, iShares MSCI Singapore, even though it holds 100% Singaporean stocks, that fund is a U.S. situs asset. So be careful with that. That's why I say in general, U.S. persons generally shouldn't be buying U.S. funds if they can help it. Next question, will there be a recording of the webinar for reference later? Yes, if you have registered to this webinar with your email address, you should be getting a recording of this sent automatically to you by tomorrow. If you don't and it doesn't work, I might be expecting a fairly large number of emails on this. I also hope to download this recording and share it with you later. Next question, is TLT estate taxable? I'm guessing by TLT, you're talking about the iShares 20+ year US Treasury ETF. It's a very highly liquid ETF holding long-term US Treasuries. Short answer is yes, it is a US situs asset. So if you want to hold long-term Treasuries as a non-US person and not have it counted as a US situs asset for tax purposes, buy the long-term Treasuries directly. Do not buy a US fund that buys those, because that fund is a US situs asset, even though the bonds inside are not. The other option, of course, if you don't want to buy the bonds directly, is to buy a non-US fund that holds those same ones. There are UCITS funds domiciled in Ireland and Luxembourg that hold long-term Treasuries. Next question, for a brokerage, is asset geographical location based on the brokerage registration or the fund location? Again, I don't give tax advice, but my understanding it's based on the domicile of that asset. So if you have a Schwab US brokerage account, my understanding, and again, this is not tax advice, is that if you own a Luxembourg domiciled UCITS fund in that Schwab account, or you won't own a Schwab account, in an Interactive Brokers account, for example, that's not a non-US situs asset. Same thing too, if you own shares of a foreign stock, or even of an ADR traded in US dollars on a US stock exchange, those are all considered non-US situs assets, even if they're held in a US brokerage account. So that's an important distinction to make, is if you are a foreign person with a US brokerage account, in many cases for those clients, I will make specifically non-US situs friendly portfolios in those US brokerage accounts, made mostly of bonds and ADRs with less than $60,000 of US situs assets in a US brokerage account. So that's, in a way, the best of both worlds: the privacy, the low cost, US brokerage platform, but all the taxes sorted. Next question, if I receive dividend as shares instead of as cash, am I still subject to withholding tax? That's a good question. I actually don't know off the top of my head. My understanding in general was that if it comes from a U.S. source, the U.S. will apply that withholding. In my experience, the IRS is very principled. It very much function over form, as opposed to other tax authorities, which are form over function. The IRS says, what are you actually doing? You're sending $100 to a foreign investor. We need to withhold 30% of it in some form or another. Next question, what would be the simplest and most cost-effective of these tax planning strategies for relatively small holdings of U.S. equities, i.e. to manage withholding taxes on dividends? Again, excellent question, and it really depends on what you're trying to do. If you're really just trying to buy the S&P 500 or broad strategy, the simplest, most cost-effective would just be to buy a competitively priced foreign fund. So if you want to buy the S&P 500, buy a foreign domiciled, let's say Irish or Luxembourg, UCITS domiciled S&P 500 fund, if that's what you want to buy. If you don't like the S&P 500, see if there's another fund manager index that you like. If, on the other hand, you want to do it directly, the example that I mentioned is, let's say, Amazon. Can you trade the Amazon position using options so that instead of having $100,000 worth of Amazon shares, you just have $5,000 worth of options that give you the exact same exposure? There are a number of different ways of doing that before we look at any of those structures that we're talking about. But again, once it starts getting big and complicated, the costs of setting up those solutions become more and more worthwhile. But again, I've met very, very large accounts who are happy with just, let's say, an MSCI USA quality tilted portfolio, and they'll buy that as an Irish fund on the London Stock Exchange. Next question. You mentioned many corporate funds. So are all corporate bonds exempt from situs tax? I do not know. I can find, if you want to send me a follow-up email, I can send you the source of where I got that interpretation. That I got it from, I believe it was either PwC or EY. There are these papers that do that interpretation of what is considered a U.S. situs asset. I will send you some of those references, and you can see what's implied there. Can you suggest a good source list that lists all of the Ireland and Lux UCITS ETFs? Also another excellent question. So generally, if you are looking for exchange-traded funds, the best sources for lists of those are really the exchanges themselves. So it really depends on what exchanges does your broker provide access to. If your broker gives you access to the London Stock Exchange or the Milan Exchange, step one is to just go to the exchange, go to the London Stock Exchange, go to the section that says ETFs, and it'll give you a list of all the ETFs. Now, the problem with that is it'll give you all the ETFs. It may not give you all the information you need. It'll give you maybe ISIN codes and volumes and so on like that. But you can go through them and you can start to see who are the major providers. You will see familiar names: iShares, State Street Spiders, Vanguard, Lixor, DWS. You'll see a few of the big names and a few independent names as well. But one thing that I like, obviously, as a professional a fund shopper, as you might say, I love looking through fund fact sheets. I spend a lot of my ferry rides going back and forth doing that. So I will probably have a lot more fun looking through those lists of funds than you do. So obviously that's why clients hire me to go through those. But short answer, go through the list of stock exchanges, and then if you have providers that you like, iShares, Vanguard, go to their UK websites or Italian websites or wherever you like to get your list of funds and look there. Next question. If the husband and wife share the same password of the brokerage account, then there won't be a probate procedure and therefore no estate tax, correct? Okay, so that's a tricky one because you're really talking about a probate question. Technically, what probate does is it's the process for transferring legal title. So just because you share a password doesn't necessarily mean that legal title is there. And where it gets a little more sensitive, if you say, I'm going to give my son the password of my account, he's going to go in and do that. I would be a little bit careful on that because the IRS is pretty savvy on watching out for those things. If they say, okay, someone has actually passed away, and then right afterwards they went in and did the transfer, you could possibly get into trouble. Obviously there's a difference between a single name and a joint account. Or actually, if I'm reading your question again, if you're saying the husband and wife share the account, so it's not they're sharing the password, they have a joint account. One of the benefits, obviously, of a joint tenancy with rights of survivorship account is that there's no probate for the surviving spouse to get the assets. Then, of course, when that surviving spouse has the account, they need to do the estate planning to get it to the next generation as well. So although I don't know if the question is really meant to be trickier in saying sharing the password as opposed to sharing the account in joint tenancy, that's one thing I would point out there. Next question. What if my Interactive Brokers account was opened in Hong Kong or Australia? Does it matter? That's also an excellent question. So I've spoken with one lawyer who's handled a probate case for a client who passed away in Hong Kong, and they said they had no problem transferring the Interactive Brokers Hong Kong account to the next of kin without paying U.S. estate taxes or filing anything with the IRS. I would not take that gamble if I were you. The IRS, in theory, could at any time look at who's the ultimate beneficial owner of these Amazon shares. And if they find out some Interactive Brokers Hong Kong account has passed away with $500,000 of Amazon shares, they could say, hey, wait a minute, there's estate taxes that need to be filed. Will Interactive Brokers ultimately be reliable for that? Will they come chase you down for that? I don't know, but I don't want to be the first investment advisor to find out. I would rather plan a way to do it, the best way possible, so that when that headline comes of, Hong Kong client gets, sacked with 500,000 US dollars of estate taxes for, Amazon shares and brokerage account, that's not me. If I buy and sell S&P mini futures via my IB account, is that capital gain subject to any US tax? Short answer, for a foreigner, not under current law, not under any condition that I've seen. Foreigners are in fact very large traders of S&P 500 E-mini and lots of other futures contracts because they get to enjoy those profits, and currently there's no capital gains regime on them. Okay, excellent. And then last question, and I will need to run and catch my ferry. Would the joint survivorship account in Interactive Brokers help? So short answer there, the joint tenancy account in Interactive Brokers basically means that if you have, let's say, a husband and wife, or any two joint tenants for that matter, that when one person passes away, the other person gets immediate control over the account free and clear. There may be some estate tax consequences of one person getting from there and there. That's really a little bit beyond my pay grade. I should have clarified it first. I'm mentioning a lot of these issues, but overall, that's things you look at there. And sorry, one more question here. If I own more than 60,000 US dollars non-US shares in Interactive Brokers account open in Hong Kong, Singapore, would the estate tax apply? So just to repeat the answer I mentioned earlier, I did see one case from a lawyer who handled a probate case in Hong Kong where they said they did the probate case with more than $60,000 of US shares in the account, and they did not face an IRS issue. But once again, I would not take that chance, because in theory, the IRS could always look through and they would say the beneficial owner of these shares changed through a probate process, and somebody will have to be on the hook for that, for that estate tax. I believe that even though a few probate cases here may have gone through without that catching their attention, I do believe the IRS is eventually going to catch up on that. So I would say, even though right now it's in theory it's possible you can get away with it, I would not take that chance. I would say that as a foreign person, I would be very careful about holding more than 60,000 of non-US situs assets. Now, again, whether or not you're going to be captured in that depends on your overall situation. It depends on it, any estate tax in your home country and any estate tax treaties you might have, and so forth. But as a general best practices procedure, we try to avoid having more than $60,000 of US situs assets in any non-US person's direct account for now. So that's it for now. Thanks again for attending and for all the questions. I hope I've done a good job of answering some of your most frequently asked questions on investing in the US while avoiding some of the tax traps. Once again, you should have my contact information, and we'll be getting a copy of the recording shortly. Thanks again, and have a great night.